All right. Good morning, everybody. We have a lot on the agenda today. So, as we generally do, I want to just start at Thinkorswim, go to the Market Watch tab, look at the calendar. We want to see the Econo Day events for today, and we don't want to get distracted by a bunch of other things. So, if your Market Watch looks like this, remove a lot of that clutter. Just hit the Show All button, make everything go away, and then turn on Econo Day event. What I generally do is just grab that description and bring it over next to the time. That way it's easier to grasp what it is that I'm looking at. It's the little things, that just make life a lot easier. Okay, so we have 8:30, 9 o'clock, 10 o'clock, 11 o'clock. The retail sales are important, but it's not our nation. So, it would be more of an emerging market kind of kickback. So nothing we're really going to worry about today. These production numbers are not just production. These numbers today are going to really be impactful. We're talking about change event for the rest of the month, at least until earnings kick off. And earnings are on the way. I mean, we're creeping right up on it. We're going to see them. If you're new to trading, you didn't know, we're going to see it in finance first. Now that ties directly into kind of the move we seen yesterday with the dollar, the bond, and the financials making a move. And I've seen a lot of new traders hand pick one or two bank stocks and say, oh, wow, look at this market. JP Morgan, Goldman Sachs, Bank of America, you can hand pick one or two companies and find a chart pattern that looks good. But you would be better served asking, why is that bank stock moving? Did Goldman Sachs suddenly do something special and amazing? Did you even happen to look at the peer group that it belongs to? And that's where you will get a deeper understanding of the move you may be looking at. So after we look at the calendar for the day, we look at the futures first, and then we look at stocks. So today, Redbook, ISM Manufacturing, we've got the 4-week bill announcement. Jolts, if you're new to Jolts, this is kind of like the take this job and shove it kind of survey, right? This is people won't quit a job if they don't see uh, recourse somewhere else, right? If they can't imagine finding a job somewhere else, they won't leave the job they have, no matter how much it sucks. But if they see greener pastures somewhere else, they will quit a job. And so it's actually a perspective of how comfortable people believe the job market is. If it is a tight market where they really don't see they're going to have an easy time finding new employment somewhere else, they will hold on to what they have. And so when this number goes up, showing people are taking this job and shoving it, then it kind of does imply that there is a broad labor market where they have the pick of the litter. They can go and choose someplace better, right? The grass being greener. The 4-week bill announcement kind of ties into when we have those additional auctions. So just kind of line up on 11 o'clock and realize what time it is. All right. So let's kind of dig into these real quick before we go too much farther. Supplies. Now, this is, if you don't have it, I recommend you go get it. Bloomberg offers a free email every single day, 5 things you need to know. And this is from that. This talks about supplies and it's talking about OPEC and crude. Yesterday's OPEC Joint Committee cut its estimate for global crude supplies for surplus in the first 3 months of 2022 by 25%. They think the impact from Omicron is going to be mild and short lived. The increase in output comes as producers are showing signs that they are struggling to meet quotas. So keep your eye on crude. You remember last Wednesday when we were doing the morning briefing, I talked about USO and the possibility or opportunity for a nice little intraday trade opportunity. Yeah, we got that. We got that and then some. All right. So crude is should be front and center. We ignore it a lot, right? Because we think, well, it's impacting the S&P just isn't what it used to be. And that's true. It's not what it used to be, but it's still there when it wants to be. Markets rise. Another thing that is in that email that comes out in the morning. This is where you get a little bit of a perspective of what happened while you were sleeping, what's going on around the world. There are times where our market bleeds over into the nighttime and we see reciprocation around the world. And then there's other times where around the world starts the morning or starts our day, and then we follow through with their exuberance. So it's just a nice little perspective of what happened around the world, what was going on in the Asian Pacific, what's going on in London, and just a little bit of a feel for what's up, right? How did they do? Was there anything standing out that we should know about coming in from that end of the world? And then it gives you a little bit of a rundown on the economics for the day. Today we've got the jolts, we've got auto sales data, we got someone from the Federal Reserve chipping their teeth today. So just a nice little heads up on what's going on. It's a free email. Doesn't take anything more than you just going over to Bloomberg and signing up for, you know, 5 things to watch or 5 things you need to know. It's just a nice little rundown. So bring it over to the futures. Looking at the ES, we're on a daily chart. We always want to start with that daily chart. You know, a lot of times we'll come out and we'll look at it daily and there's just nothing here. And so we just kind of shrug and say, well, I looked, I just didn't see anything worth noting. That's fine. At least you looked. But I guarantee you, if you never come out here and you never look, then the one time that it would have benefited you from coming out here and taking a look, you didn't get that benefit. So it doesn't matter if you're a day trader, come out to the daily chart. Look at the weekly and the monthly once in a while. You would be surprised at what you may come across. This lower indicator is one I don't normally have on the screen, but I was talking with Dan this morning and I went and brought it up and I just had not turned it off yet. This is the advancing versus the declining cumulative average of the New York Stock Exchange for 252 days. That's a mouthful. It's market breadth of the New York Stock Exchange. When we look at it on the year, you can see where the trend line has been going, and you can see how the market has been sideways, allowing it to catch up. We're getting that nice little bump. Now, this is change event time, right? This is where it's like make or break. When we tie that right back in with the futures, we're sitting at all-time highs. We're beginning to expand, right? This is make or break time. We're there. We're going to see a resolution of this very soon. Because one thing we cannot do, one thing we have never done in the history of the market is just stay there, right? We're not going to stay in this very tight range. We will resolve this, and it's coming. Which brings us into today, right? Oh, that's a very cute little micro head and shoulders. It's already reached its target, by the way, but yeah. All right. So almost a Busby style make and break, right? And we've talked about this setup many, many times. When a market expands very fast, what it often does is come right back down and reset. Now, that reset does not mean that it's done or that it's over with, that the bullish exuberance that made this pop happen in the first place isn't gone, right? Sometimes it is. There's just some little bump. We make a move, we fade right back, and then it's just forgotten. But oftentimes, this is a precursor to the move, right? And it kind of fits right in with a Busby. This is not a Busby. We can say that it's not a Busby because it's already broke down too far. But the move has been reset. So if that bullish exuberance still exists, we will see this reclaim this previous level more in a controlled move rather than this impulse that we saw back here. If it's short lived and there's no more impact from it, then we're just going to see this continue to do whatever we were doing before that pop happened. And what we were doing was making a move to the upside, right? So just advancing to the upside. We are up 0.25%, and yet we have an ADR right now. Wait for it. 1.2%. So we have another 1% in the wings that we could run, and it would still be considered normal. Now, granted, 12 hours have already passed. We only got 0.25%. So at the very least, we could have an expectation that we could get back to the top of the range. That's just 0.25%. That would be a half of a percent on the day. We could take it a little farther than that and say, well, what would an additional half of a percent look like? 48.21. Well, we got to get through the cog line at 48.11. Cog lines only exist on the ES and they only exist at the 11s. You don't need an indicator. You don't need a tool. There is nothing if you go and look for it in the Discord. Cog lines are just 11s and just on the ES. And so don't go, on some wild rampage looking for some indicator that will mark cog lines for you. You're going to just have to get your drawing tool out, mark the 11, and only mark it on the ES. Easy enough, right? Breathe. So if we can make it through that, get our move to the upside, reclaim this level, and then from that, in the intraday, we'll be using the 5-minute fib style that I've been teaching everybody. It works really, really effective, and it helps teach you how to use it even while you're using it. Right? It's kind of like the more you use it, the more comfortable you are using it, and you'll be able to expand it and use it in different ways. Just start it with the way that I've been teaching it. That'll get you where you need to go. A downside move today, if we should happen to go the other direction, would first, more than likely, have something to do with left shoulder, head, right shoulder. Now, we don't have it yet, but it's very likely that we're going to see something like that. It's a head and shoulders pattern. This is a very ugly version of the same thing back here, right? That is a 15-minute head and shoulders neckline break, and we can actually just measure the entire thing, especially with Thinkorswim's new drawing tool. So on your mouse, where the wheel is, rather than rolling that wheel up and down, push down on it. It's actually a button. That brings up the shortcut menu. You want the quadrant lines down at the bottom, and this is going to measure 100% of the move for you. That would be our downside target, the low of the Globex. Pretty close, right? There's no reason to split hairs. So a downside move from that head and shoulders on the neckline break would put us right near the bottom of the Globex. That would be the target to the downside for the day. And keep in mind, we could make that move and it wouldn't even be considered bearish. So don't run out there and try buying a bunch of puts and SPY. This move would not be much of anything, just be a shrug and another day at the office. So now we've got our downside target and our upside target on the ES. Let's jump over to the Nasdaq. At a market in expansion, it's what they do, right? Price aggregates. That megaphone pattern is popular for a reason. This does not necessarily imply direction, only that price is expanding. And it makes sense, like I showed yesterday when we were looking at the book map, of where the liquidity is and how large traders have to reach a little bit farther to find someone willing to provide liquidity. If you look back at the rejection, institutional pivot points from back here, Globex high or the high of Wednesday, Thursday's high, we revisited those levels. First touch was a hard rejection. That's a real easy play, right? First touch rejections. If the market gets a little bit of a bump from the econ today, the very first thing we'd look for is reclaiming this Globex level, and then we will aim for these highs back here. Now that may seem like just too far, right? We can't make that. It's just so far away. Well, we got an ADR of 1.8, an average daily range. Well, if the average is 1.8, if the norm is a 1.8% move on the day, that's only 0.97, right? That's not even a 1% move. The NASDAQ can easily make that move. So that would be our upside target. If things remain bearish, we could see a break to the downside and revisit these previous lows. There's a slight speed bump right around 450. If we manage to get through that, then we'll look around the 350 area. If you think that that is too far away, same thing again, just get your drawing tool out. It's not even a 1% move to the downside. And markets, generally speaking, move faster down than they do up, right? If we could make a 1% move to the upside, we could easily make a 2% move to the downside. That's not even 1% away. There is, of course, the third opportunity or the third thesis, the idea that we could just stay in the range. This is a fairly wide range for the Nasdaq. All things being equal, we could just stay from this Globex high to this Globex low and do nothing more than what we did back here, right? Sure, we peaked out of it a little bit, but for the most part, we didn't do anything, right? It was one of those days. And the same thing the next day. Now, there's this strange idea out there that I can't trade this. It's not that I can't trade it, it's that I recommend people who are struggling don't trade it. Why should you? If you're struggling and you're new and you're losing money frequently, quit trying to trade in this environment. Wait for a better environment, wait for a clean market. And then people wonder why I trade a lot in Globex. Well, look at that and then look at that and ask yourself, well, which of those would you rather trade? Well, I'm already up in the Globex. Why not be day done here and just avoid this and trade something else in the intraday if that's the kind of day I'm going to get? Because when I look at this, what trades do we have? Failed flag? No. Head and shoulders? No. Rising wedge? No. 5-minute open range breakout? No. Busby? No. Okay, well, those are the pivot plays. What do we got left? All right. Bounce off at Globex low. Okay, that was a good play. Just not a lot of setups, right? So it's not that I can't trade this. It's that if you're losing frequently, I recommend you don't trade that. Then you won't lose so frequently. Do the easy stuff. Don't do the hard stuff. Wait to do the hard stuff later after you've got a little bit of experience and you're not losing so much. It was an impressive move yesterday in the dollar and in the bonds. I got to admit, I was like, wow, right? I mean, like, dang, wow. That was some impressive moves yesterday. We really want to keep our eye on this today and see if we're going to see more of it. And look at that consistent, persistent move in the VIX. They are unloading in there systematically, right? You're talking about carrying insurance. They are not carrying insurance. They're getting rid of it hand over fist. We're moving into a risk on environment, right? Like, yeah, time to get it. Firing up the engines, kicking the tires. They're checking the oil and making sure it's ready to go. But we really want to keep our eye on these two, right? Even when we don't necessarily understand the impact, like, oh wow, the bonds are dumping like a rock in water. What's that mean for my market? Well, it didn't necessarily correlate into an explosive move to the upside, right? We didn't see like a teeter-totter effect where one side went down and the other side went up. That's not what we had. But we did have some very extreme, very violent moves yesterday. Those extremes and that violence came from these two markets. And if you look at what happened in the financials yesterday, look at JP Morgan and Goldman Sachs and Wells Fargo. The banks like and benefit from higher interest rates, right? They make money by loaning money out with interest. So when interest is high, they make more money. They've got earnings coming up. They got to be held accountable, right? They like this. The tech does not like this. So it's a little bit of a catch 22, especially when a lot of the finance are actually tech and it's fintech. So it's just a very bifurcated, choppy, disjointed market. I mean, look at the Russell yesterday. Talk about a head fake, right? Everybody was like, yeah, yeah, yeah. Wait, no, 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 wait, no, never mind. Forget it. Just kidding. Psych. Just pretend. It doesn't even know where it wants to go. So keep your eye on the dollar, keep your eye on the bonds. We're looking for exaggerated moves. Uh, Bloomberg is a good place to get more info on the dollar. Thinkorswim is another one that will often have, like, in the Thinkorswim videos, they'll talk about the dollar a little bit. You can even go to FX Street, which I've recommended more than once going over to FX Street, mainly from the idea that it will show you economics on the day and then give you a color code for their severity expectation. But while you're there, when you're at FX Street on the economic calendar, there is a little byline from this dude right here, and he talks about the dollar frequently. You need a consistent source who understands the dollar on like a more informed level. I'm not a 30-year economist, right? I haven't gone to school and gotten an education in economics. You want to find a source that has a very strong understanding of the move that we are seeing in the dollar, because the dollar chart alone does not give you the information you need, the why behind it, right? And this is free. If you go to FX Street, don't give them your email address. You can sign up, you can log in, and it is free, but they will harass you in that email nonstop. So either give them a fake email address or, adjust your spam settings, because these guys are like annoying as hell. But you don't have to sign in. I'm not logged in. I can see what I need. There's our econ for the day and our severity level expectation impact right there. Right. See how it got darker, and it's just a full dark bar. So we have that expectation that it's going to be impactful, and it's free. Right. Everybody likes free. The dollar, the bonds, the VIX. Watch the four indexes. I keep this grid up all day long. If my computer is on, this grid is up, generally set to a 15-minute on all of these. And then if an opportunity presents itself, it's pretty easy to see and take my chances at that point. The Dow Jones. This was my go-to watch list when I was new. One, because I didn't know how to create a watch list that I would find valuable. Right? I was new. I didn't understand the ways that we can funnel the wide world of stocks down into a manageable, tradable list. So I just used what Thinkorswim already had, which is the Dow Jones, the S&P 100, the Nasdaq 100. Well, the Dow is a bunch of household names. They're good companies, usually mega cap. They're liquid, good options. It's a really good starting place if you're new. Just use the Dow. You can always, you know, uh, grow as you learn and develop your own watch lists. But if you don't have one and you're looking for a place to start, that's a really good place to start. It has diversity. You can find longs, shorts, sideways trades, different sectors, different industries. It's just a nice, well-rounded watch list. When you add sectors and then your indexes, you're good to go with around 50 markets, right? And 50 is more than enough. So you can see here on this list that we've got some of each kind. We've got possible rallies, possible pullbacks, possible downtrends, upside momentum, every direction we would want to go, right? And a lot of the names in there are the financials that are showing that move. American Express, Goldman Sachs, JP Morgan, Visa, all with upside momentum. That makes sense. Look at the move we just saw, right? Then you start getting into like retail, and uh, we're getting a little bit of a bump there. Nice recovery. Could see Home Depot giving us a red to green today. That'd be nice. Nice little recovery. I was actually talking about this move yesterday, not in Home Depot, the setup for a long trade. So let's go ahead and take it out to TrendSpider. Look at the sectors this morning. Airlines, energy, finance. Makes perfect sense, right? Finance is bouncing around because of the dollar and the bonds. We just looked at the post from Bloomberg about energy and jets. I mean, if we do have that reopening this year that they were looking for last year, and it really, to me, it's been the pill, right? They've been working on that pill. If we can find a way that people do not need a shot but can just take a pill, then we're really going to see the world begin to normalize, right? That's going to be like the last straw, and they're working diligently at it. There are some projections that this year there will be a pill to replace the shot. And it makes sense that they're front running in the airlines because that's when travel and industry is really going to start to kick off again, right? So they're kind of front running it. But like I've said before, be careful looking at a beaten down sector and thinking, oh, yeah, I'm going to get in on the ground floor and run this back up. You could be waiting for years. The airlines are not really well known for uh, good business practices and strong money management, right? So, just kind of take that with a little bit of grain of salt. Still, the sectors are looking fairly decent this morning. Emerging markets are flat, and that's a little bit of a concern. But if they're waiting on the sidelines for our econ to come out, then it does make sense that nobody's putting a toe in the water yet. So we are going to be able to lean on the sectors, which is good, right? We can always start with that and kind of ask, can I just use the sectors for my trades today? Of course, we can just skip past that though and go right to things that have weekly options. And it's a good list, right? Things that have weekly options are numerous this morning that are up more than a half of a percent. You can see we got to scroll a long ways before we get to a half of a percent because there's that many names that are positive this morning. Now, the reason I have two lists, if you're new and you haven't seen these streams, is because if you scan for quote weekly options, you get over 600 names. I can't have one watch list with 600 names on TrendSpider, so I had to break it down into two watch lists. That's the only reason that there's two of them. Otherwise, it would just be one big long list. And you can still see that there are a lot of names on this list. What we want to do is not necessarily pick on one name. We want to look down that list and see if these names lead us to a peer group, a sub industry that may be a benefit to trade. Because when we're looking at quote sectors, that's old school. That thing's been around forever. And you know what we don't see in these sectors? We don't see crypto. We don't see pot. We don't see EV market, right? It's not breaking it down into these smaller micro industries. It's just like the broad-based S&P 11 sectors. Well, I mean, that's fine. It's a good start, but we got to go deeper on our own, which is why I build a watch list like the EV watch list, or coming in and looking at a watch list built specifically to look at the chips, right? And chips are looking pretty good this morning. Crypto, again, looking really good this morning, right? So we've got plenty of names on the list to focus on. I would continue to focus on energy and finance. There's a lot of cheap companies that are really liquid and fun to trade. You can day trade, swing trade, you can do it all in there, right? And you can do it even when in a smaller account. So I would continue to focus on those. It's where the entirety of the market is focused right now. And plus, they've got earnings coming up. Everybody's looking at them. They are the day trade, right? Said it yesterday, and I'll say it again today. They are where your opportunities lie. They're not the only thing out there, by all means, right? You can certainly find something else. Just if you're finding it hard to find something to day trade, yeah, look at energy and look at finance. Tech starts to get really expensive really quick. It is up on the morning, by the way. So, I mean, there is that. Okay, so this is TradingView. We're on the S&P 500. We want to sort it by pre-market change. We need to use the filter because we don't really want to see 500 names. We want to knock that down to around 100. It's hard to actually hit 100, but I'm close enough with 91 names. There's a lot of gray here because it's not responding to change percent until it gets to 50. So we want to adjust that so that it changes sooner. Wow, now we got some color. All right, so we just filtered the S&P 500 and turned it in basically to that S&P 100, changed it by market cap. So we got a pretty good list of names here, and you can see where um, there's some weakness, right? Technology on the health side, retail's weak. Amazon's big enough to make things hurt, right? So, we're a little bifurcated. We got a little bit of both, some positive, some negative. I had to really keep my eye on that technology on the healthcare side of things. We want to swap this one to the Nasdaq 100. Again, just change it to pre-market change. We don't need a filter because it's 100 names already. We're just going to give it a color code adjustment. So we can see retail trade, health technology, consumer services, consumer non-durables. So consumer, producer, communications, utilities. It's not looking so hot in the Nasdaq, huh? A couple of these really big names are getting it done, and that's it. Everybody else just really isn't helping all that much. To put it into a better perspective, we use this kind of scan, right? In this kind of scan, we're doing a pre-market change percent above or equal to whatever we pick. And right now, this is the S&P set to 1%. How many names are up at least 1% in the S&P? Two, GE and Ford. How about a half of a percent? 19. We'll just round up and say 20. 20% of the S&P is up at least a half of a percent today. That's not bad. It's okay. Certainly not bullish exuberance, right? We're not feeling the fire here. How about for the Nasdaq? The Nasdaq pre-market movers above or equal to a half of a percent, not even 10 names. So definitely not much exuberance, right? Just a whole lot of a little bit of nothing. So there is a wait and see. This is a market waiting for a catalyst. Um, we need those economic numbers to come out and then trade the reaction off of those numbers. Don't try to front run it. You don't know what the numbers are going to be, and you don't know how they're going to react to it. Let the reaction begin to unfold and then trade that. Works out well. That is our market. Everybody, have a good morning. Be safe, be careful, and I will see you all tomorrow.